Something unusual is unfolding beneath the surface of the global financial system, and most people haven't fully grasped it yet. Markets move every day, prices rise and fall, headlines flash across screens, and investors are told that everything is normal. But every so often, the signals coming from the monetary system begin to line up in a way that suggests something far larger is approaching. The kind of shift that doesn't just move markets for a few days or weeks, but changes the direction of the entire financial era. Right now, those signals are starting to appear. The first thing to understand is that the modern monetary system is built on confidence. Not gold, not silver, not physical reserves stored somewhere deep underground. Confidence that currencies will hold value. Confidence that debt will be repaid. Confidence that the institutions managing the system still have control over it. But confidence is fragile, and when the structure supporting that confidence begins to crack, the entire system can start to wobble. Over the past several decades, the global financial order has gradually moved further and further away from tangible monetary anchors. Instead of money backed by physical assets, the world shifted toward a system where currency is created through debt expansion. Governments borrow, central banks purchase that debt, and new currency units are effectively created out of financial promises. For years, this system appeared stable because the expansion was gradual. Markets adjusted slowly, asset prices rose, credit expanded, governments continued borrowing, and investors continued buying the debt. But the pace of that expansion has accelerated dramatically. What used to happen over decades is now happening in years. What once required extraordinary crises now occurs as routine policy responses. Liquidity injections, emergency support measures, large-scale debt purchases, and financial stabilization programs have become common tools. At first glance, these actions seem to stabilize markets. When financial stress appears, new liquidity enters the system and markets calm down. Stocks recover, bond markets settle, headlines shift from panic to reassurance. But underneath that surface calm, another process is quietly taking place. Every new intervention increases the amount of currency in circulation relative to real goods and services. Over time, that begins to erode purchasing power. Not overnight, not in a sudden collapse, but gradually, year after year. Most people experience this erosion in simple ways. Everyday expenses rise, housing becomes more expensive, food costs climb, energy prices fluctuate upward. The same amount of currency buys less than it did before. These changes are often blamed on supply chains, corporate pricing decisions, or temporary disruptions. But the deeper cause lies in the structure of the monetary system itself. When currency supply expands faster than the real economy grows, the value of that currency slowly declines. This dynamic has been building for years, but recent developments suggest that it may be entering a new phase. One of the most important signals comes from the bond market. Government bonds represent the foundation of modern finance. They are considered the safest assets in the system because they are backed by the full financial capacity of the issuing government. Pension funds hold them, banks hold them, insurance companies hold them, central banks hold them. In theory, these bonds provide stability. But stability depends on one key factor: confidence that the debt can be serviced. When governments borrow heavily, investors eventually begin asking a simple question: can the borrower continue paying interest and rolling over existing debt without creating even more currency to do it? As long as growth remains strong and borrowing remains manageable, the system functions. But when debt grows faster than the underlying economy, pressure begins to build. And right now, that pressure is becoming increasingly visible. Bond yields have started moving upward. At first, this may appear like a technical market adjustment. Yields rise and fall frequently depending on economic expectations. But when yields rise in response to growing debt risks, it sends a very different message. Higher yields mean investors demand greater compensation for holding government debt. And that creates a dangerous feedback loop. When yields rise, the cost of servicing government debt increases. Higher interest payments require either higher taxes, reduced spending, or additional borrowing. In practice, governments often choose the third option. They borrow more to cover the rising cost of previous borrowing, but additional borrowing places even more supply of bonds into the market, which can push yields higher again. This is sometimes referred to as a debt spiral. At first, it unfolds slowly. Small increases in yields, slight adjustments in borrowing costs. Market participants remain calm because the changes appear manageable. But when the debt burden reaches a certain scale, the system becomes extremely sensitive to further increases in interest rates. Even modest increases in yields can dramatically raise the cost of servicing national debt. And once that threshold is crossed, financial authorities face an extremely difficult choice. Allow yields to continue rising and risk destabilizing the entire debt structure, or intervene directly to suppress yields by purchasing massive amounts of government bonds. That second option effectively means creating new currency to absorb the debt. In other words, expanding the monetary base even further. And this is where precious metals enter the picture. Gold and silver have served as monetary anchors for thousands of years, not because governments declared them valuable, but because they possess qualities that make them naturally suited for preserving value. They are scarce. They cannot be created at will. They cannot be printed or digitally generated in unlimited quantities. When confidence in paper currency systems weakens, people historically return to assets that exist outside the credit system. That process doesn't happen instantly. At first, markets often react in confusing ways. Precious metals may even decline temporarily as capital moves into cash during moments of uncertainty, but those moves can be misleading. Short-term price movements are often driven by liquidity events. When markets panic, investors sometimes sell whatever they can in order to raise cash. That includes precious metals. However, once the immediate liquidity scramble passes, the deeper forces driving the crisis begin to reassert themselves. And when investors realize that the response to financial instability involves creating even more currency, the appeal of hard assets can increase rapidly. Right now, the precious metals market is showing signs of unusual tension. Price volatility has increased. Sharp declines appear suddenly. Rapid recoveries follow. Large trading volumes move through the market during short windows of time. To casual observers, this may look like ordinary market activity. But beneath those fluctuations lies an important fact. There is very little speculative enthusiasm in the precious metal sector compared with other asset classes. Technology stocks, growth equities, and various speculative assets have attracted massive attention over recent years. Meanwhile, gold and silver markets have remained relatively quiet by comparison. This means something important. When a market is already crowded with speculative investors, price movements can quickly run out of momentum. Everyone who wants to buy has already bought. But when a market has very little speculative participation, it has far more potential energy stored beneath the surface. If a shift in investor psychology occurs, the movement into that market can be sudden and dramatic, and that is precisely what makes the current situation so interesting. While precious metals have experienced downward pressure in recent sessions, broader macroeconomic conditions are evolving in ways that historically favor hard assets. Energy markets are becoming increasingly unstable. Shipping routes face disruptions. Insurance coverage for major transport corridors is becoming uncertain. When global trade routes experience stress, commodity flows can slow dramatically. Energy prices rise. Manufacturing costs increase. Transportation becomes more expensive. These developments ripple through the global economy. Higher energy prices act like a tax on economic activity. Businesses face higher operating costs. Consumers face higher prices. Economic growth slows. At the same time, governments facing slowing growth often increase spending in order to stimulate the economy, and that spending frequently requires additional borrowing, which brings us back to the debt problem. If growth slows while borrowing accelerates, the ratio between debt and economic output worsens. Investors begin demanding higher yields to compensate for increasing risk. And when yields rise during an economic slowdown, financial markets become extremely unstable. Stock markets are particularly vulnerable in this environment. Equity valuations over recent years have expanded significantly. Price levels in many sectors have reached historically elevated ratios relative to earnings. High valuations are sustainable only when interest rates remain low and liquidity remains abundant. But if bond yields rise significantly, investors suddenly have an alternative. Instead of purchasing equities with uncertain future earnings, they can earn competitive returns by holding government debt. That shift in capital allocation can place enormous pressure on equity markets. As capital moves toward bonds, stock prices begin to fall, and falling equity markets create another dangerous dynamic. Many financial institutions use equities as collateral for loans. When stock prices fall sharply, the value of that collateral declines. If collateral values fall below required thresholds, lenders may demand additional collateral or force asset sales. Those forced sales can accelerate market declines. This is how financial crashes sometimes begin. Not because investors suddenly decide to sell everything, but because the structure of the financial system forces selling once certain thresholds are crossed. History has shown how quickly such processes can unfold. What appears calm one week can become chaotic the next. The real question now is whether the monetary authorities can maintain control over this process, because if the response to rising yields, falling equity markets, and slowing economic growth is simply more liquidity injections, the long-term implications for currency value become increasingly severe. The more currency that is created to stabilize markets, the more pressure builds on purchasing power. And once the public begins recognizing that pattern, confidence can shift very quickly. For years, many investors believed that modern financial authorities had essentially mastered crisis management. Every time markets stumbled, new liquidity entered the system and stability returned. But the scale of intervention required today is vastly larger than it was decades ago. Each new crisis requires larger responses. Each new response increases the overall size of the monetary system. And eventually, a point may arrive where maintaining stability requires such massive currency creation that the value of the currency itself becomes the central issue. When that moment arrives, attention turns toward assets that exist outside the paper system. Gold and silver have historically served that role. And the signals now emerging suggest that the world may be approaching another one of those pivotal periods in financial history. The markets may not fully understand it yet, but the early warning signs are beginning to appear. When large financial shifts begin, they rarely start with a single dramatic event. Instead, they emerge through a series of small signals that gradually reveal a much bigger picture. At first, these signals seem unrelated. A shift in bond yields here, a disruption in shipping routes there, a sudden change in how certain countries manage their reserves. Each development appears isolated when viewed individually, But when those signals begin aligning, the pattern becomes impossible to ignore. One of the most significant developments unfolding right now is the quiet transformation of the global monetary landscape. For decades, international trade has largely revolved around a single dominant currency. Commodities have been priced in it, energy contracts have been settled in it, governments have held it as their primary reserve asset. This arrangement created a powerful feedback loop. Because global trade required that currency, countries accumulated it in large quantities. Those accumulated reserves were then invested into government debt, issued by the same nation that produced the currency. In other words, global trade helped finance government borrowing. As long as this system functioned smoothly, it created a stable foundation for global finance. Governments could issue large amounts of debt knowing that international demand would remain strong, but systems built on trust can begin to weaken when geopolitical tensions rise. And recent developments suggest that several major economies are preparing for a very different financial environment. Instead of concentrating reserves in a single currency, some nations have begun quietly diversifying their holdings. They are reducing exposure to certain assets and increasing allocations to alternatives. Gold reserves have been rising steadily in multiple regions. Central banks have been purchasing physical metal at levels not seen in decades. This trend alone would be notable, but it is happening alongside another important shift. Certain financial institutions have reportedly been encouraged to gradually scale back holdings of specific foreign government bonds. On the surface, such adjustments might appear routine. Financial institutions regularly rebalance portfolios based on market conditions. However, when these changes occur simultaneously across large segments of the financial system, they can signal something deeper. It suggests preparation. Preparation for a scenario where the stability of the existing monetary order may no longer be guaranteed. One possible explanation lies in the increasing use of financial systems as geopolitical tools. Sanctions, trade restrictions, and financial controls have become common features of modern international relations. Access to payment systems, reserve assets, and trade financing can be restricted during conflicts. For countries observing these developments, the implications are clear. If access to key financial networks can be restricted during geopolitical disputes, relying too heavily on those networks creates vulnerability. The logical response is diversification. That diversification can take many forms. Some nations expand trade agreements denominated in alternative currencies. Others accumulate larger reserves of physical assets such as gold. Still others reduce exposure to foreign debt instruments that could become politically sensitive in future conflicts. These moves are rarely announced loudly. They unfold quietly over years, but their cumulative impact can be enormous. When global demand for a particular reserve asset begins to decline even gradually, the financial consequences can be significant. Government debt markets rely heavily on consistent demand from large institutional buyers. If those buyers begin stepping back, yields can rise. And as discussed earlier, rising yields introduce severe stress into heavily indebted systems. But the financial landscape is not shifting only because of reserve diversification. Energy markets are also playing an increasingly central role. Global energy flows depend on secure transportation routes. Tankers move through narrow maritime passages carrying enormous volumes of oil and natural gas. If those routes become unstable, even temporarily, the effects can ripple across the entire world economy. Insurance coverage for shipping through sensitive regions can disappear almost overnight when geopolitical risk rises. Without insurance, shipping companies are unwilling to risk vessels worth hundreds of millions of dollars. When ships stop moving, energy supply chains slow, energy shortages push prices upward, and higher energy prices affect everything from transportation to agriculture to manufacturing. The result is a form of economic pressure that spreads rapidly through global markets. Consumers feel it at fuel stations, businesses feel it in logistics costs, governments feel it through inflationary pressures. But there is another dimension to energy disruptions that is often overlooked. Energy price spikes can accelerate the breakdown of fragile debt structures. When economies slow due to rising energy costs, tax revenues decline. Governments collect less income while facing greater spending demands. At the same time, higher inflation can push bond investors to demand higher yields. Once again, the debt spiral begins tightening. Now imagine these dynamics unfolding simultaneously. Rising geopolitical tensions, energy market disruptions, declining demand for certain reserve assets, higher bond yields, and overvalued equity markets, vulnerable to sudden corrections. This combination creates an extremely unstable environment. When markets finally recognize the scale of these pressures, reactions can be swift. Capital flows shift rapidly between asset classes. Investors search for stability in an increasingly uncertain landscape. Historically, during such periods, precious metals have played a crucial role. Gold tends to respond first. Because it is widely held by central banks and institutional investors, large reallocations toward gold can occur relatively quickly. Silver often follows later, but its movements can be far more dramatic. Silver occupies a unique position in the financial system. It is both a monetary metal and an industrial commodity. Industrial demand for silver spans electronics, energy technology, medical applications, and advanced manufacturing. At the same time, silver shares many of the monetary characteristics of gold. When financial instability rises, investment demand for silver can increase sharply. But because the silver market is significantly smaller than the gold market, Even modest inflows of investment capital can produce outsized price movements. This dynamic has played out repeatedly throughout history. Silver often remains quiet for extended periods, moving slowly within relatively narrow price ranges. Then suddenly, when financial conditions shift, silver begins accelerating. The move can surprise even seasoned market observers. One of the reasons for this volatility lies in the structure of the silver market itself. Large amounts of silver trading occur through derivative markets rather than physical metal transactions. These derivative markets allow participants to take large positions with relatively small amounts of capital. During calm periods, this structure creates liquidity and efficiency, but during periods of stress, it can amplify price movements. If investors begin demanding physical metal instead of paper claims, supply constraints can appear quickly. Physical inventories available for immediate delivery are often far smaller than the total volume of paper contracts circulating through financial markets. When confidence in paper claims weakens, the scramble for physical metal can intensify rapidly. This is one of the scenarios that precious metals investors watch closely. Not because it happens frequently, but because when it does occur, the price adjustments can be extreme. Right now, several early indicators suggest that conditions are slowly moving in that direction. Physical metal demand has remained resilient even during periods of price weakness. Central bank purchases continue. Retail investment demand appears to be strengthening in certain regions, and most importantly, the broader macroeconomic backdrop is becoming increasingly favorable for hard assets. If global debt pressures intensify while currency expansion accelerates, the fundamental case for precious metals strengthens significantly. Yet despite these developments, many mainstream investors remain largely disengaged from the sector. Most attention continues focusing on technology growth, artificial intelligence, and equity market momentum. Precious metals remain on the sidelines of popular investment discussions. And that lack of attention may ultimately become one of the most powerful catalysts. Because markets tend to move most dramatically when investor positioning shifts suddenly. If a point arrives where confidence in traditional financial assets weakens, and investors begin reallocating capital toward hard assets, the flow of funds could be enormous. And given the relatively small size of the precious metals markets, compared with global equity and bond markets, even a small percentage shift in capital allocation could have outsized effects. This is why some analysts believe that the next major movement in precious metals could be exceptionally powerful. Not because of short-term speculation, but because of long-term structural changes occurring within the global financial system. Those changes are not always visible in daily headlines. They unfold gradually, quietly, through reserve diversification, energy market tensions, and evolving geopolitical alliances. But when enough of those forces converge, the results can reshape the entire financial landscape. And if that moment arrives, gold and silver may once again step into the spotlight as the world searches for stability. The signals emerging from the financial system today are not random. Rising debt pressures, shifting global reserves, fragile energy supply routes, and increasingly volatile markets all point toward a period of profound change. For years, the monetary system has relied on expanding liquidity and growing confidence, but those foundations are beginning to show strain. If the coming months accelerate these trends, the reaction across global markets could be dramatic. And in times when currencies weaken and financial structures face stress, history has shown that attention inevitably returns to the same timeless stores of value. Gold and silver have endured through centuries of economic upheaval, and if the warnings now flashing across the system continue to intensify, the next major chapter for precious metals may be closer than most people realize.